Good
This
morning,
meeting is recorded.
good afternoon, good evening, depending on where you are. Thank you for joining us today for this panel conversation where we'll focus on LP expectations for GP sustainability strategies. I'm joined today, and I will let them introduce themselves as they get started, by Nina Krause, Matt Shea, and Paul Fahey. And so the idea is to really dig into what's new around this topic. When my partners at Novata reached out with this concept, I said, well, what is new? Because this is the age-old question, what LPs want from GPs. And so today we'll talk about some developments in the space from both a voluntary and regulatory reporting perspective, and some changes that we've seen in these reporting strategies and ongoing conversations. So thank you to our panelists for joining, and let's get started. So Nina, I'll start with you because we've talked about this at length, and I know you've got thoughts on this topic. But given the sort of mandatory regulatory questions that you need to be reporting on, beyond that, what are some of the ways that GPs can think about narrowing the focus and picking the most material metrics to report on, given that there are hundreds, both voluntary and mandatory?
Absolutely. I think this is a great place to start. I spend a lot of time thinking about this topic, and thanks to everyone who joined. I'm the Director of Sustainability at Hamilton Lane, overseeing and leading our sustainable investment strategy, corporate strategy, as well as our dedicated sustainability team. And additional responsibilities are also overseeing ESG, as well as climate initiatives. So this is a big part of every day for us and for me specifically. I think the important thing is for general partners to always start with what is material at the asset level. When we bring this topic back to ESG and risk management and the intention of focusing on materiality, it is to manage material risks. And so each opportunity will be different. There are resources that are available to support identification of material risk factors, such as SASB and PRI. Those are great resources. As well as I think, increasingly we're starting to see general partners just ask and get consultants involved almost on an every deal type basis to support their teams in identification and building strategic mitigation. But as you flow up to what LPs need, you start thinking about risks at the portfolio as a whole level. Not only the fund level, so the GP portfolio as a whole, but also the LP portfolio as a whole. And so what becomes material to making those decisions on how to make a whole fund decision or tilt a portfolio strategy one direction or another, those are different metrics. And so I think one of the perhaps misconceptions in the market, and one of the areas that there are a lot of groups trying to demystify, is that when we talk about materiality, we're not always talking about the same concept of asset level materiality, and that really being transparent, meeting people where they are, and drilling into the language that people are using and what they really mean by it is the first step in starting to identify how we can tackle these questions. And then I think, as I look out into the ecosystem, there's been a lot of progress around aligning to metrics that are relevant both at the asset level, but also can be rolled up at the portfolio level. So just pointing to some of the EDCI work has been really positive, I think, as we look at what GPs are reporting on and the potential of LPs using that, aligning it to performance and also making portfolio decisions off of it. So really important topic. It's not done yet. And so as questions come up, I think we all in the industry have a lot of work to do to make sure when we're talking about things, we all understand what we actually mean by what we're saying.
I think that's great advice. So clarifying, whether we're talking about asset or portfolio level. I think that takes us right to our next question, which I'm going to direct to Matt and to Paul, which is, some misconceptions or maybe misalignment. And Matt, I saw you come off mute. It's probably because Nina mentioned EDCI. I'm sure you've got a lot to say there, but if we could talk about, alignment, common misconceptions, I think that would help us with this, introducing the concept part of our conversation.
Sure, and thanks very much, Lorraine, Novata, and Private Equity Wire for having me here. My name is Matt Shea. I'm a managing director for external affairs and sustainable investing at the Institutional Limited Partners Association. So ILPA works worldwide to support and advance the interests of our more than 600 LP members across private markets asset classes and globally. I think that the common misconception that I've landed on that I thought was worth sharing here, I've observed specifically around the disclosure of certain KPIs, most commonly emissions and diversity metrics, which many LPs are looking to collect that information from GPs across kind of their entire portfolio. And the misconception I think is that the data has to look good the first time it's disclosed or reported. There's a temptation whenever you first collect data to want to benchmark and improve upon it. And I think that the current state of data obviously may not reflect the desired future state, even 1 to 2 years out. And so if you're a GP on this webcast and that resonates with you, I would say many LPs are themselves in a similar position. And so while the state of data and disclosure is certainly better than it was 2 to 3 years ago, thanks to Lorraine, firms like Novata, and industry efforts like the EDCI, Nina, which you mentioned, and I'm happy to talk about. It's still far from ideal. This is still kind of early innings in terms of collecting data and reporting it. And so I think what's important today is disclosing what you can. We're all on the journey of starting to collect and improve disclosure processes together, but also providing the commentary around the processes that you're putting in place that will ultimately improve how you monitor and manage those material considerations, whether they're material to the LP across the portfolio or to your specific sector and business. I think that goes a long way today in differentiating where you're at, and isn't necessarily, today LPs are not necessarily making decisions based on where the data is today. They're thinking about where that data needs to be 3, 5, 7, 10 years from now.
Yeah, some great points there. Last but not least, Paul, your thoughts on that topic?
Yeah, so thank you, Lorraine. I'm Paul Fahey, part of the Northern Trust. I'm responsible for our many fintech relationships that we have that are focused on delivering value to our asset owner, asset manager clients, particularly around their front office and effectively enabling them to execute on their strategy. Novata falls under my purview, and I've been heavily focused on all things ESG. I think it's interesting in this space, in the private market space, because we're challenged in the public market space where we'll say there's a lot of information available to still feel comfortable with the completeness of that data. And I think what we're seeing in the private space is that completeness, I won't say accuracy because that's a little bit too of a judgment call, but certainly the completeness of that data is even further challenged. I would go back and maybe take a half a step back to when we talk about the metrics piece. It really is about the investors looking at what are they trying to achieve. And I think at times we have a tendency to conflate the risk management piece of sustainability management with the impact investing. And we talk in terms of those two being one and the same. And I think we'll see those differ, particularly for those that maybe are ERISA governed versus endowments and foundations that maybe have a little bit more flexibility in what they're trying to achieve. You mentioned the regulators. I think the regulators have driven a lot of this to date. I do see that changing, and I see more of that coming from the investors really pushing the managers and GPs to deliver against those reporting requirements. But clearly articulating what those reporting requirements are, I think we're still a ways off from investors being very, very clear, both what they want to achieve and communicating those out to the GPs.
I think that's a great point, and I'll open it up to everyone really to comment on that. So, we've got this global regulation coming at us at a very fast pace. On the carbon side, at least there's some common ground with it being grounded in the GHG protocol, but look at California, US SEC, and in APAC, our team's watching closely since we've just expanded our footprint to be on the ground in Singapore. So, I'd like to open it up, beyond the data that we know we're getting our hands on, at the regulatory requests, where is this going, beyond that voluntary investor requested data? What are your thoughts there, everyone?
Well, I think from the LP side, there's an interesting dynamic between some of the regulation that's coming in, and there's obviously the regulation that is mandated and non-optional and is very clearly articulated. There's regulation that is coming out in waves of clarity and disclosure and direction, and likely we'll have 1.0, 2.0, 3.0 versions over time. And then there's a set of optional commitments for investors that once you commit to, there are portfolio implications. And I think that's the category where there's a lot going on, I think, in the LP side today. And what I would say broadly is the regulations, as far as where I mean, they're there for a purpose. They are there to either enhance disclosure, set alignment, set criteria, or shift a portfolio tilt. And so these decisions are not to be taken lightly from a portfolio perspective and a regulatory and compliance perspective, because once they are commitments, they really have to be complied with. And so we're seeing a lot of preparation go into getting ready to make some of those optional commitments and diving into what does it all mean from a portfolio standpoint. I think from the GP side, the thing to, I would say, be probably front-footed on as LPs navigate an evolving regulatory landscape is to know your LPs. Know what they are going to commit to, know what optional regulations or disclosures they may have in mind in the future, because this could really change your LP mix and how investors can approach a re-up process or a new diligence process.
That's great. And I'll open it up, the same question to Matt and Paul, and then I've got a follow on there.
So I'm not gonna take out the crystal ball and try to predict where regulators are gonna go next, and particularly here in the United States, it's a big question and a pretty hot topic. But I think there are two things to keep in mind here. You have to pay attention to the regulatory regime in Europe and what's happening there, regardless of where you're positioned, because LPs are global investors. And so, the chances that as a US-based LP, you may be investing in a business that has exposure to the European market, or conversely, if you're a European GP raising capital or looking to scale a product to a certain, into a certain market, those are things you're going to have to deal with. But you also, even though many smaller companies and so that would fall kind of in the private markets arena, may not be directly subjected to many of these regulatory requirements. The effect as you go upstream is real. I mean, if you're going to buy or sell to a publicly traded company in the US or Europe, they're going to send questionnaires to you about certain practices and looking for certain types of disclosures. And so, waiting for regulatory clarity, particularly here in the U.S., is probably not the best strategy. You probably want to be getting ahead of it. And I think to Nina's point, one of the best things you can do there is ask your investors what they need and kind of why they need it, so that you can position yourself to meet those requirements, if not today, in the near future.
Yeah, I think that's great advice. Paul, what would you add?
Yeah, I would say that last piece
Yeah.
from Matt around the investors, this gets back to my earlier comment where I think the investors are going to drive a lot of the demands for the GPs. In part, it's driven by the lack of clarity around the regulators. The one thing I would say, and to somewhat link to Matt's other comment around the global nature of this, it may be less about being in one country and worrying about the requirements in another jurisdiction. It may be that you're responsible for multiple jurisdictional reporting. And shockingly, the regulators aren't always in lockstep with each other from jurisdiction to jurisdiction. Right. So you may be required to report on multiple things that, in a standard regulatory environment, single market is a little bit more manageable, still difficult with lack of clarity. But when you start going beyond your own jurisdiction and dealing with multiple, that challenge is just exponentially more difficult.
Yeah, agree with you. And you may also see different timelines for reporting out on different metrics, which is, something we've seen looking at California. So, that takes me to, we've talked about collaborating and really understanding expectations when you're setting up a reporting strategy. Talk to us, and I'll open this to everyone. Tell us more your thoughts on this LPGP conversation around the sustainability reporting strategy. How prescriptive are some of these requests getting? And what, from your perspective, does good look like in terms of having a reporting strategy in place?
Yeah, I'll jump in to just kick off. I think based on everything that we've said today, I think one of the good practices is optionality. If you are restricted to a requirement that, as we've said repeatedly, is less clear, you'll go down a path, and the ability to back away from that and then expand the reporting or shift or pivot becomes increasingly more difficult. But again, I think this conversation between the GPs and the LPs and really understanding what are the LPs trying to achieve, what are the requirements being placed on them, and you start to get a coalescence of opinion when you start to talk to a lot of LPs. And we've had a number of conversations actually in partnership with Novata, with some of our clients here, and you start to hear some recurring themes. And I think if you can start to package those up, play them back to the LPs, I think you'll start to see a picture of what those requirements are looking like. You're still going to get outliers or people looking for something that maybe is unique to them. But I think generally, if you're solving 80+% of the requirements because you're listening and understanding and collecting that feedback from the LPs, I think it's going to put you down the path in a healthy way.
Great. Matt, Nina?
I would just add that it can be an open conversation with your LPs, and in some of these conversations about what will be required, what may be committed to that's not yet committed to. I mean, there are solutions to build together, and I think Paul alluded to this, that everyone's working in largely the same construct towards very similar goals. And the goal is not to miss reporting or not comply or not deliver what LPs are looking for. I mean, the GPs we work with are all working very hard to deliver information to us, as are their portfolio companies. And so sometimes I think GPs can be part of this conversation on what is the reality, how can this happen in a more streamlined fashion? How can it be less painful if it is, with different competing interests at the LP level on different timelines? And how do we have those conversations about positive solutions for everyone and then bring those back to the industry.
Yeah. Matt, I saw you come off mute. And anything else to add on that topic?
Yeah, well, with respect to kind of what best practices for GPs look like to make sure they're meeting LP expectations, I think the challenge here is, and this kind of goes beyond just what's required from a regulatory perspective, but what LPs are looking for in terms of data and disclosure is going to vary extensively, based on the type and the size of LP, what their stakeholders want, the geography in which they operate. Today you have LPs in the United States who are required to ask certain questions about ESG, and then you have others who are discouraged or prohibited from asking, explicit questions about ESG. And I wanted to kind of make 2 points there. One is we've released a resource several years ago that's available to the entire industry called our ESG assessment framework, which was put out there to help LPs and GPs evaluate and benchmark kind of their own responses to due diligence efforts. And so if you Google ILPA ESG framework, that'll be the first thing that pops up, and it's available to anybody who's curious to have a look. We'll be announcing an update to that framework in just a few weeks in May. But the key differentiator, right, if you think about what really makes you stand out as advanced or leading practices, your ability to not only provide the data, but to explain why the data's decision useful to your firm. And so GPs who can link their ESG initiatives directly to value creation strategies are, who are able to show how they identify material considerations, how those considerations then create more resilient and profitable businesses, and then how that work results in higher sale prices, are the ones who stand out. And that also helps you cut through the political narrative here in the US, or if there's anti-ESG, pro-ESG crowd. At the end of the day, you're in the business about talking about value creation. And if you can show that linkage, then you're able to avoid a little bit of what Paul was saying, this conflation between ESG and impact, and this conception or misconception that there's ultimately a financial trade-off to doing some of this work.
I think that's a helpful topic for us to dig into, and even to put a finer point on the messaging and how we see that evolving. We've seen very specific guidance across the life cycle of the investment. So how are you talking about ESG during due diligence, ongoing monitoring? I know Nina's nodding because these are things that she does. And then, and what are LP expectations around during the fundraising process? So I'd like to open that up to all of you, starting with Nina, but just LP expectations for this type of information. And we can start with fundraising and open it up to the group to talk about other times when this is key to communicate.
Yeah, so absolutely. I think that the fundraise is interesting. We've seen a big evolution in this over the last five or 6 years. I remember 5 years ago having conversations with investors who were not preparing their strategy, articulating it, and communicating it outwardly and proactively in their fundraises. And that I think started to become problematic at that time. And so we've seen a big shift where really the strategies are clearly articulated. Investors are asking, and GPs are sharing without, I would say, much friction at all, exactly how and what they're doing, as well as any sort of data or defensibility that they can provide behind it. Because in lieu of really outside in diligence or consultants coming in to do oversight reviews on some of these practices, it's up to the LPs to do the diligence. And I think we're all aware there are a variety of styles and ways in which LPs do that. And so for us, we just expect it to be really open book. We utilize Novata. We've loved really getting down into the data in a fundraise beyond just the documents provided to us. And then leveraging all of that to really prepare for a fully integrated due diligence around how these metrics, how the data, how the strategy contributes to value creation, as Matt mentioned. And so this is really a multi-pronged approach in our DD, at least, where teams are drilling into this topic through all conversations of on-site meetings, through our ODD work, as well as in broader conversations. And so it is, I would say, once you start getting into those conversations, at this point in time, fairly easy to start seeing where the teams are relative to what's been provided. And I would say a big probably limitation to where we see GPs is, Lorraine, exactly what you mentioned, this communication point, how to talk about your strategy and how to educate particularly investment professionals who may be doing the work, but may not understand exactly how it's being communicated out to LPs. That link seems to be a big one for GPs starting their journey, and is one that I would encourage everyone to continue double clicking on, because we still see very robust ESG and sustainability strategies, but when we really dig in under the cover, start finding some of the challenges around communicating that, and that leads us, I would say, to question the communication to management teams and other stakeholders around what really is being implemented here and how valuable is that to LPs. So that's our expectation at DD. I'm going to stop there probably and let others chime in here, but we can attack monitoring afterwards maybe, because it's a whole another animal.
Sure, it is. And thanks for that overview. And I think, along with just communicating on your efforts, it's talking about the governance behind that. When we did our survey with Oliver Wyman last fall, we saw a whole range in terms of what the governance could look like for this type of program. And so just sharing out, who's got oversight, what are the different controls in place, especially as we come to some of these regulatory requirements where assurance is part of the conversation. Anything else, Matt, Paul, to add to this, fundraising portion? We can also jump into how we know if GPs are meeting LP expectations. What are some ways to find out?
I'm happy to jump in. I don't know. I think I touched on a couple of these points a few moments ago, but the part maybe to come back to is to find out, you should ask. I think it's that they're fully recognizing that all of the ESG diligence has become quite a process compared to where it was 5 or 10 years ago. And there are often a lot of questionnaires that get traded across, and but are we stopping for a few minutes to make sure that we're both LPs and GPs asking questions, providing feedback, and sharing a little bit more about the kind of why behind either the decision to ask a question or the decision to answer a question or not answer a question in a certain way. I know everybody is incredibly busy in this industry, but hopefully you are able to find time to schedule that follow-up call to provide some feedback or to ask some of those questions that really help you understand if what you're providing meets the expectations of your LP, because to generalize on behalf of all LPs is really quite difficult to do.
Yeah, I agree. I think it.
Nina, anything you'd add there based on what Matt has shared?
No, I completely agree. I think LPs have different processes for assessing these matters as well. For us, I mean, I articulated a fairly IDD heavy process, but also integrated through ODD and our dedicated sustainability team. Some LPs house a lot of this diligence within just the dedicated team. And so really understanding also the decision points within your LPs on how this gets absorbed, interpreted, and then integrated into their processes is really important beyond just understanding, I would say, the broader needs. And then the pausing to ask the questions, that's really critical and almost goes straight back to the start, where when we talk about materiality and when we talk about these things, there is a lot of room for misunderstanding. And when we drill into the foundational elements, there's a lot of great work. And I think there's a lot of enthusiasm and the right intentions behind what's happening. But we often can get caught up in a miscommunication spiral and not understanding certain things. And so I absolutely agree with Matt on that topic.
That's great. And I think that's something we've seen change. I know it's something we've seen in the past 3 years, is that LPs are sharing more on how they're using this data at both the portfolio level and the asset level. So, asking for the data and then sharing back where is it going and how is it part of their process. Matt, anything you would add to that? You're closer to it.
Yeah, I think there's going to be kind of two lenses by which you're going to view it, and this gets back to what's material to an LP and what's material, to the fund and to the portfolio company investment at a specific level. You certainly see a lot of LPs who are taking a look at the emissions footprint of their portfolio, across the board, trying to understand both the physical and transition risks that their portfolio in aggregate may be facing, or their exposure to certain types of industries. Some have begun kind of creating climate solutions sleeves, or making kind of more tactical investments in this space. So that's kind of one set of questions, right? Other LPs have prioritized DE&I, and to them that's an important criteria, and so they're looking to understand not only they're looking for diverse representation across their fund managers and fund managers deal teams, but some are also asking questions about the composition of portfolio company boards, and we saw the demand for that through the Data Convergence Initiative, which has expanded the level of depth that it goes into, not only looking for kind of portfolio company board diversity, but also extending that with an optional metric into C-suite diversity last year. And so those are two that really stand out, but and they're using those to understand kind of the makeup of their portfolio. But then when you get to kind of materiality-based sector specific metrics, that's where LPs may be looking for more commentary from their general partners, that's why you're hiring GPs and not doing these deals direct, is because of the expertise that they have. And so I think that goes back to the point I made earlier about value creation. With the metrics that you're providing, being able to articulate how those inform how you manage and grow a company, and being able to speak to the value that improving those metrics adds to the company, is probably what's most informative.
You're taking me to my next topic, and we've only got, a short while left. So really, it's how are you talking about value creation and creating these opportunities at the companies? How can we make sure we're not just reporting for the sake of reporting? And Nina, I'd love to hear your thoughts on this topic as well.
I mean, absolutely. I think we're all aligned on not reporting for the sake of reporting if it's not being used. The challenge is always going to be LPs do need some of these more comprehensive data sets, whether it's for regulatory reasons or to manage their portfolio risk from a materiality standpoint. But as we think about what is relevant and what is material, I mean, this comes back to the identification process at the beginning. And for us, and I do think for the GPs we talked to, some of the big challenges around, okay, there are all these data requests, but actually what's material is not really captured. Can we add that? Is there scope to talk to our LPs around that? And I would just say absolutely. If you are identifying other material elements, managing to them and driving value that way, that is part of your sustainability or ESG strategy. Highlight that, talk about it, communicate it. And LPs will absorb that, whether it's absorb it into how they think about diligence or monitoring that portfolio from a more micro risk standpoint. I think there is a broad evolution where, you know, it's not just about standardization. There is scope to do more and highlight things outside of where we're aligning. From our perspective, there isn't a big challenge around that, and we're absorbing both. Just to maybe note on our monitoring process, we do outside-in monitoring, but also are monitoring and expect to monitor our portfolios quite regularly. So we're looking at assets on a quarterly basis. And then I think a lot of, frankly, the metrics are coming out at different times, or they're being moved towards regulatory and or reporting deadlines. But actually what comes out of those interim discussions on outside-in monitoring, driving stewardship and engagement with our GPs on the assets, those conversations can be really enlightening about really if the strategies are being executed upon and either further validate our expectations and our underwriting, or lead us to a path where we actually can get involved and support a general partner moving towards best practice. And so I think there is scope outside of what we've been talking about to layer into these discussions with LPs.
Thank you, Nina. And I'm just going to do a quick call for questions from our audience. You can submit them via the chat, and in our last 5 minutes, we will try to tackle your questions. So send those in and we'll go through those. Paul, Matt, I'd like to open it up to you. So we were talking about just creating value for our companies, going beyond just the reporting, and how GPs and LPs can support opportunities based on what we're seeing through this data collection. And then I'd love to hear your thoughts on that. And I'll close this out with a last question, which is on contextualizing the data, which I know you all have thoughts on since we talked about it earlier today. So finding opportunities within the data, working together, LPs and GPs to add value based on what you're seeing come out in this reporting.
Yeah, I'll start. I think some of the conversations that I've had with data providers broadly is they're seeing a lot more inquiry around the data itself. So being able to offer that data up, if you think about portfolio companies, maybe themselves looking for fundraising, that data becomes I was going to say valuable, it's almost a prerequisite. So in a lot of these, you're getting the companies themselves are being asked about what is their ESG footprint or what's their sustainability approach. So being able to expand the use of the data. And then obviously the metrics, you know, you're talking about people having long-term horizons around whether it's their net zero approach. What are those metrics that they can measure their progress against? And so are they capturing that data? Because clearly you don't want anyone showing up on, December 31st, 2050 or 2049 and say, well, we've missed our target. So being able to monitor along, so using the data and the benchmarks that you can derive from that data will become increasingly more valuable.
That's great. So, intermittent reporting, conversations about these big, big goals and ideas, and just making sure there's progress, right? As opposed to holding back on that type of disclosure. Matt, what would you add just more broadly to the conversation?
Yeah, I mean, look, the technology that's been developed to help portfolio companies, GPs, and LPs collect and exchange and benchmark the data is terrific, and that will make this easier. It's certainly easier to get a hold of some of this data and benchmark it than it was even 2 or 3 years ago. But I think equally impressive has been the way that the private equity industry has gotten together to try to solve this problem as a collective group. And I think the Data Convergence Initiative, while it only covers 6 or 7 metrics, and that's certainly not the end all be all for any thoughtful sustainability related conversation, that it covers a couple of the big ones that are of broadest relevance to LPs as they look across their portfolio, and to GPs as they think about the responses and the disclosure requests that they're getting. And that initiative now is over 425 LPs and GPs. So I imagine most of the folks on the webcast will have probably heard of it. But for those who haven't, I'd encourage them to take a look at esgdc.org, or feel free to reach out to me if you have any questions. And I know the Novata platform also, not only provides the mechanism for EDCI reporting, but a lot of the guidance and handholding that can help portfolio companies fulfill that ask.
Well, it's a fantastic effort. My thoughts there, and yes, we do support reporting to EDCI. It was just a no-brainer for us in terms of showing people where to get started. And they've done a lot of legwork in terms of bridging this gap between LP and GP needs. So I think that's great to recognize, especially in this part of our conversation. Nina, Paul, what else would you share on contextualizing the data? I spent a lot of my time talking to GPs and LPs about what's going on broadly. Where's this reporting going? And storytelling is so key. I mean, just having a number on a page is not as helpful as having the full context. So benchmarking, analytics, what else would you share, just even from your own experience day to day, on contextualizing the data and how that changes the conversation?
Yeah, I would say just, and I'll let Nina finish up, but I would say we talk a lot about the ability to collect the data and the platforms and the technology making that easy. It really comes back to the expertise and having people that can sit there with the data and explain where it's coming from, where it's going. If this was all wrapped up in a nice little bow, it'd be easy. But we need people to be able to talk about what the data is telling us today and where it's going, because clearly we are early on in the process. I talked a little bit about the public markets. There are a lot of challenges there. They're exponentially higher with the private market space. And being able to have a conversation knowing that this is going to evolve over time, you need people that are deep in this, have real expertise, have seen this evolve over time, and have a sense of where it might go rather than a full-blown solution.
Sure, and we can learn a lot, right, from where we've seen public equities go in that type of disclosure. Nina, over to you.
Yeah, I think I mean, I'll leave it probably short and simple. I mean, this is all going to get connected to performance data. And at the end of the day, it is about validating that value creation, as Matt said, managing risk of portfolios and of assets. And so at the end of the day, it's connected to performance. It will be measured on a performance basis, and this can iterate. I mean, we are not done. As we connect these data points into performance, there are going to be lessons, there are going to be learnings on a market as a whole basis on what really is or is not relevant in the short, medium, and long term. And so I think I'll leave it at that. But I'm excited about the future.
That's a great note to leave it on. So thank you, Matt, Nina, Paul, for your insights today. I think we're all excited about where this is going and understand how big of a lift it is. But to everyone who joined, our panelists are accessible, and so you can feel free to reach out to each one of us via LinkedIn. And thanks for joining us today. So I'll leave it there. Thank you.